reporting by CNBC raising questions about whether markets may have gone too far in interpreting extremely hawkish comments yesterday from St. Louis Fed President Jim Bullard. Senior economics reporter Steve Leisman has that story. What are we talking about here, Steve?
Brian, reporting by CNBC finds several Fed officials, both privately and publicly, pushing back against calls by St. Louis Fed President Jim Bullard yesterday for supersized rate hikes and even inter-meeting hikes, which, as you know, rocked both bond and stock markets. The comments of these Fed officials suggest markets may have wrongly interpreted Bullard's remarks as being widely held by other Fed officials and by Fed leadership. Reporting by CNBC finds these officials either not supporting outright or very skeptical of a 50 basis point rate hike in March, which the market priced in following Bullard's comments. While there's a chance the committee may do that, the initial indication is that Bullard may, for the moment, be an outlier on the rate-setting FOMC or Federal Open Market Committee. Instead, these officials appear to favor measured 25 basis point hikes, with a decision to accelerate that pace only coming later in the year if inflation is not responding to the Fed's actions. Atlanta Fed President Raphael Bostic, reached yesterday by CNBC after the inflation report, said, "My views have not changed for 3 or 4 rate hikes this year, likely beginning with a 25 basis point hike." That was the view he gave CNBC on Wednesday before the inflation report. And Richmond Fed President Tom Barkin said in a speech last night that, quote, "I'd have to be convinced of the need for a 50 basis point hike," saying there may be a time for that, but it did not appear to be now, according to his comments. CNBC reporting found that most Fed officials were already looking for a bad inflation report going into the number, and the January report was not substantially worse than they expected. Not a single official, in fact, expected improvement in this report, and that improvement is not expected to come till mid-year. In addition, officials were heartened that markets had already begun pricing in substantial rate hikes and didn't see a need to bring forward any additional tightening. San Francisco Fed President Mary Daly said after the inflation report, quote, "A 50 basis point rate hike, quote, is not my preference." Now, there's still 5 weeks before the meeting, and the situation could change, but it seems likely at the moment that the market has placed an awful lot of weight on a single Fed president's comments, while CNBC reporting suggests at least several Fed officials continue to favor a more measured response. Brian?
A lot to unpack there, Steve. Okay, here's the thing. If many on the Fed believe that inflation is transitory or will slow down, the president said yesterday he expects inflation to kind of tamp down by the second half of this year. If they believe that's going to happen, how many rate hikes would be appropriate? Because if you do believe that inflation will naturally work its way through, why then, like Goldman Sachs now is calling for, Bank of America's been calling for, why would you need 7 rate hikes?
So a couple reasons, Brian. The first thing is, think about a world or the economy without 7% inflation. Let's say inflation was 2%, but let's say the unemployment rate was 4% as it is now, that the economy had already pretty much clawed back all that it lost during the pandemic. Wouldn't you be setting rates higher in any event? Wouldn't you also be running off your balance sheet in any event? The idea, and I've been sort of on this story since the December meeting and certainly since January, is that we're not in a moment here of decisive forward guidance. The Fed is going to be much more data dependent than it had been in the past. During the pandemic, the Fed said, hey, we're going to be low for a long time because the economy is running below its potential. Now the economy is at potential. The inflation is high. What's going to happen here, I think, is a measured pace of increases by the Fed, balance sheet reduction. What the Fed is going to do, though, is hold back any possibility of accelerating until it takes a look around and says, look, we have 100 basis points of tightening already in the market. We're going to do some balance sheet reduction. Let's hold that back for another gear. Brian, you're very into automobiles, is my understanding. You understand that, if you want to go higher, you need to go up a steeper hill. You want to hold back a little bit, and that's where the Fed is right now.